Hi Glenn. How did the Harmony portfolios fare in January?
Well, it was a difficult month for the portfolios. In fact, all portfolios produced negative absolute returns in January after what had been a very strong 2013 with positive returns in most months in 2013, and the year started with actually quite a bang on the downside. Returns varying between minus 0.8% on sterling balance to minus 2.8 on the Asian growth fund. Asian markets being amongst the worst hit in the sell-off that we saw in January. So it was a tough start to the year, but we need to bear in mind that equity markets really were very weak in January. So comparing the Harmony numbers against equity markets, developed equity markets, MSCI World, was down nearly 4% in the month. Emerging markets down 6.5%. So again, the Harmony funds helped to preserve capital in a very tough risk-off period in markets, and of course, risk-off period meant that safe haven assets such as government bonds performed well. And we had very little exposure there, so I think our numbers actually held up well under the circumstances. And looking back over the past 12 months, we still have very good positive numbers from all the Harmony funds except the two Asian funds, and Asian markets have gone through a pretty tough period over the past 12 months or so. So yeah, quite a difficult start to the year.
Thank you. What were the main themes for the month?
Well, I think the critical thing during the course of the month was what was happening to emerging markets, and the sort of mini crisis we're seeing in emerging markets, which had not spread more widely through 2013, began to impact other markets. So we had a classic risk-off period where equities performed poorly, and safe haven government bonds and other perceived safe haven assets like gold and the yen actually performed very well. So that was the most important factor that was driving the markets and the portfolio performance over the month. There were a few other issues. There was a sort of slowing of growth that we saw, particularly in the emerging world, inevitably, but without question it was the events in emerging markets, the tightening of monetary policy in emerging markets, that was the important thing that drove returns in the month.
Excellent, thank you. What were the main asset allocation drivers for the Harmony portfolios?
Well, given what I've said about markets, without a shadow of doubt, the big contributor to the negative returns was the fall in equity markets, both developed and emerging. We have been about in line with our long-term strategic asset allocation targets in equities, and we've had really quite small positions in emerging market equities, so we've been relatively well protected. But nevertheless, with the scale of falls we've seen, we've obviously had some negative contribution from that. We also have had little or no positions in safe haven government bonds, because as we've consistently said, we've seen that as a very expensive asset class. Government bonds happened to perform very well in January as we saw this sort of risk-off period. So that impacted returns, although in fact our other fixed income positions in credit, high yield, actually performed reasonably well, not quite as well as government bonds, but nevertheless produced positive returns. So we had some benefit from that, and we also had a very useful contribution from our small position in gold producers. The gold price rallied 3 or 4% in January. Our position in gold producers returned about 12%. So although it's only a small position, it made a useful contribution to returns. But without a shadow of a doubt, the big driving force was what was happening in equity markets. And the reverse of that, this reduction in yields in safe haven government bonds, and hence a positive return from that asset class.
How are the Harmony portfolios positioned today?
We are about in line with our strategic allocation in equity markets. We've got a very small position in emerging markets. we are looking to add to that during this period of weakness in markets, and certainly as we go through this year, I think there will be opportunities there. But we're about in line with our long-term asset allocation positions. We remain virtually zero weighted in safe haven government bonds across all the funds. We still see that as a very expensive asset class and maintain that view, indeed even more so given what happened in January. We've taken a couple of important decisions in the course of January. We have sold out entirely of our high yield bond positions. It's positions we've held now for 5 or 6 years, and which since the beginning of 2009 have done extremely well for us. But yield levels, both in absolute terms and relative to government bonds, have fallen to historically very low levels. So we think that we've had the really big move in that trade, and from now on we think that returns are going to be relatively subdued, and indeed the risks start to increase, that you start to lose money on those, particularly if government bonds weaken off as we go through this year, which we think they will. So we're now right out of high yield bonds. We are also in the process of selling out of our loans positions. Regrettably, I might say, because we actually, after lengthy discussions with the Luxembourg regulator for these funds, we are required to sell them out. The regulator has deemed them to be inappropriate investments for UCITS funds, so we have to sell those. We now are sitting on quite high levels of cash. We had quite high levels of cash as we went into this year. We had been somewhat cautious shorter term. As at today, we'll be sitting on cash levels of getting towards 20% in the balanced funds, about 11-12% in the growth funds. So we've got quite a lot of firepower, and what we're looking to do in the process of doing with that is we're putting more money into Asian convertibles. We think that's a good way of getting low risk exposure to Asia, a defensive way of doing it. And we're looking at buying more emerging market debt, which we started to buy back in December.
Regarding the outlook, what can we expect next?
Well, we see this period of weakness in markets as a correction. We don't think it's the beginning of a sort of a longer term bear trend in equity markets. We think it's a healthy correction. It was overdue in the developed world. We recognise there are some quite significant problems in the emerging markets, but corrective action is being taken, and the adjustments we've seen in currency markets are part of that process. So as we go through this year, we think that the emerging market sector will begin to stabilise, and certainly valuations are looking a lot more attractive there. So we'll be looking for opportunities to add to positions there, and where we can, we'd be looking to add to emerging market debt positions. That's one of the most attractive areas of the fixed income sector, we think, at the moment. It's sold off very heavily. Then in fixed income, we still see no value whatsoever in safe haven government bonds, so we'll retain very low positions there, and we're looking for opportunities elsewhere in the fixed income area. Convertibles, I've already mentioned, I think are quite interesting where we can buy into those, and emerging market debt. So we'll continue to keep our fixed income exposure diversified away from safe haven government bonds as far as we practically can. But I think one thing worth reiterating is this year to date has been a very useful reminder of the great advantage of keeping a broadly balanced and diversified portfolio, with the equity content providing us with that long-term growth volatility as we've seen in January, the fixed income component providing us with that greater stability and income generation, and again January was a very good example of that. So we continue to maintain a broad diversification across all the portfolios, with arguably the biggest challenge in investing in the fixed income sector, where the key component of that, safe haven government bonds, still looks very expensive.
Excellent, thank you very much, Glenn.